Well, hello, I'm going to try this again. I am Kenny Polcar, your host of the party, and today is Wednesday, May 15th, 2024. And here are the things you need to know. The first thing you should notice is look at that sky. It's a little bit darker, it's a little bit cloudier than it was for the last couple of days, and I wonder if that is suggesting anything about the action in today's market, what the CPI might say, and how investors might react. But in any event, here's what you need to know. And by now you know that the PPI came in hotter yesterday than expected, yet stocks rallied. The CPI is due out at 8:30 this morning, so it's any moment now. Bonds rose yesterday, sending yields just a bit lower. Oil's up. Demand appears to be strong. Gold is up. Think geopolitical and foreign demand issues forcing gold higher. And what do we have at dinner tonight? We're going to have the porcini rubbed ribeye tagliata style. And tagliata style is just the way in which you present it, but it is really delicious. Okay, so stocks surged on Tuesday, right? As a rally in tech, the XLK was up 9/10%. Real estate was up 7/10. Communications, financials, healthcare, consumer discretionary, all up 0.5%. Even utilities were up, right? They were up 0.3% yesterday. What I found interesting, though, is that consumer staples, the XLP, which is the stuff you need versus the stuff you want, actually fell by 0.2%. Now, away from that, further down the scale, you saw home builders up 0.9, retail was up 2.8%, airlines up 1.1%, disruptive tech was up 2.1%, semis were up 1.6%, metals and miners up 1.1%, exploration and oil production up 0.9%, aerospace and defense up 1.3%, and this dragged everything except the transports higher. The Dow gaining 126 points, the S&P added 25 points, the NASDAQ was up by 122 points, the Russell was ahead by 24 points. Like I said, the transports came under pressure and they lost 66 points, while the equal-weighted S&P added 28 points, or 0.5%. Now, you know what else surged? Yup. Inflation surged. The PPI rose more than expected. In fact, not a little bit more, but a fairly substantial amount more. In fact, it rose so much that it even surprised J.J. Powell. Top line was expected to be up 0.3%, but it came in at plus 0.5%. And the ex-food and energy reading also came in at up 0.5% versus the expected up 0.2. And if you annualize either of these numbers, you come up with a 6% PPI yearly inflation rate, right? And so you ask, and the market rallied as investors and as traders and algos saw little reason to pull back on their narrative of a rate cut. It's illogical, isn't it? Okay, so here you go, pay attention, because here's how they managed to make that happen. They took last month's PPI read, which was plus 0.2%, and they revised it to negative 0.1%, right? So they went negative for last month. And if you annualize that negative number, you get negative 1.2%. So what did they do? Well, they blunted yesterday's hot number because now they created a negative number in the recent sequence of positive numbers. They just broke that trending higher narrative. And that must mean it's okay, right? See how they did that? See how they did that? How they created all that chaos in the middle? So once they break the trend, then the prior trend no longer exists, right? And you have to start it all over. So while the number was strong, the rate cut guys are still at it. They essentially shrugged it off as a non-event, continuing to suggest that we could still expect to see 2, maybe even 3 rate cuts this year, which again is illogical to me. Now, I was on with Liz Clayman on Monday with Drayden Pence from Pence Wealth Management, where we debated this very issue. You can find that interview on my Twitter feed, which is just at Kenny Polcari. Now, I still think we're not going anywhere this year. Drayden Pence thinks we're going to get 2 rate cuts by the end of the year, think November and December, all while Goldman is still out there pushing the 3 rate cut narrative, meaning September, November, and December, which is completely off the rails for me. Now, I say it's only traders and algos because as a long-term investor, I didn't buy a thing yesterday, right? I sat back and I let it ride. My portfolio was up 0.7%. Overall, the only drags on my portfolio were Verizon, Aptech, IBM, and XLP because they were all lower on the day. Now, I'm still waiting on today's number to really drive the next decision. Money that I have waiting to put to work is sitting in my money market account earning 5.25%, so I'm all good. Now, to be fair, if I was playing in the meme space, I would have seen much bigger returns, right? But that's not where I hang out, although maybe I should. We saw GME up 62% yesterday on top of the move the day before, and AMC was up 33%. And the UBX short index was up 5.9%. Recall that index tracks the highest interest short is the high interest short index, and it tracks the 100 stocks in the Russell 3000 with the highest short interest that are greater than $1.5 billion in market cap. Now, you know it didn't surge? The contra trades did not surge. The dog was down 0.3, the PSQ was down 0.7, the SH was down 0.4%, the VIXI was down 1.9%, and the SPSX, which is the triple leverage short, was down 1.3%. Today is though all about the CPI, right? The Consumer Price Index. Essentially what is happening at the consumer level, something I think we all know all too well, but we still have to play this game, right? Will it come in as expected up 0.4 month over month, or will it be hotter? After yesterday's PPI, it's game on. Analysts and economists lining up on both sides of the fence as they try to call this one, right? As they prepare to dissect and digest today's number due out at 8:30. And you can believe there is a lot riding on this number today. Who is calling it, and how will the algos react? If it's hot, will they still convince themselves that there's nothing to worry about, that it's a flash in the pan, or will it suddenly hit home that inflation is not only sticky, but it's actually taking new root in the economy? What will they do to last month's number, right? Just like they did yesterday to the last month's PPI number. Will it also get revised lower to soften any blow of a higher number today? I mean, can we even consider the idea that the CPI comes in softer than the expectation? I mean, you can consider it. I'm not sure how, but you can. All we have to do though is wait until the clock ticks at 8:30. I can feel the excitement all the way down here in South Florida because it's getting hot and sticky right now, if you know what I mean. But look at those clouds. They're really building more than they were even 2 minutes ago. So just so you know, the year-over-year ex-food and energy CPI reading is predicted to rise by 3.6% year-over-year. Bloomberg is out there making this claim to make sure you know it, that 3.6% is the smallest year-over-year rise in 3 years. Right? So do you see how they position that? They're not focusing on the fact that prices continue to rise. They're trying to convince you that there is nothing to worry about, that a 3.6% rise is a good thing. It's all about the power of persuasion. Now, to be clear, the year-over-year number will most likely stay even or even fall slightly because of the way they calculate it, which is why you should be looking at this moment at the month-over-month number, because that tells you where we are today and will give you the change in the trend. And so, guess what bonds did yesterday? Well, they rose on all this excitement. I'm not really sure why, but they did. The TLT up 0.6, the TLH was up 0.4%. The AG was up 0.3%. The 2 years now yielding 4.81%. The 10 years yielding 4.44%. Shorter duration bond yields, shorter duration bills. The 3 month is yielding 5.22%, the 6 month is yielding 5.15% on an annualized basis. These rates are down from nearly 5.5% just a month ago or 2 months ago. Oil this morning is trading at $78.20, just above the trend line support at $78. Crude inventories fell by 3.1 million barrels last week. The API reports that gasoline inventories also fell by 1.2 million barrels last week. Distillates rose by 675,000 barrels. Today we're going to hear from the IEA, and they are expected to tell us that oil demand is softening. I mean, it's illogical. But I think oil remains in the $78, $81 trading range. Gold gained 1% yesterday, and it's up another 0.7 today. It's trading at $23.75. This is up from $23.25 only a couple of days ago. And this is after the hot PPI report and ahead of today's CPI report. Now, why is it up, do you ask? Well, because gold traders are betting that we're going to get a softer CPI. And if they get it, they're betting on, guess what? Yep, rate cuts. And if you want my opinion, I think gold is trading up because of the geopolitical risks that remain, as well as demand from foreign country purchasing gold for their reserves. I just don't see the rate cut story causing gold to rise, but that's me. Now, we remain in the 2,300, 2,400 trading range for gold. And I think that's kind of where it's at. When it hits 2,400, it's going to hit some resistance, but we'll see. U.S. futures this morning are paralyzed, right? Ahead of the all-important CPI read. The Dow futures are up 16. The S&P is up 2. The NASDAQ is down 11. And the Russell is up 6 points. European markets are mixed. France is down 0.2, while Spain is up 0.5%. Investors there are also focusing on yesterday's PPI and today's CPI number and what that might mean for the Fed, monetary policy here, and then monetary policy across the Eurozone. The S&P closed at 5246. It was up 25 points and is now only 18 points away from the April highs. Yesterday, Fed Chairman J.J. Powell told us that inflation is not cooperating, remaining higher than he expected, causing him to reiterate that rates will remain higher for longer. Yet, the market didn't hear that. Or if it did, it no longer cares about rates, which I find interesting, right? Aren't 5.25% rates astronomical the way they've been telling us? I mean, what happened to the how can the U.S. economy survive argument? Recall that I am and I have been in the camp that 5.25% rates are historically normal and that the market can function when investors embrace it. So higher for longer isn't an issue for me, but I just think that the rate cut narrative drama has gotten a little bit ahead of itself, which is why I'm not chasing it. I let it run when it wants to, and I'm there when the market pulls back. Yavish? Okay. Remember, keep your powder dry on days like this. You can sit there and not make a decision as a long-term trader right now as long as you're invested. See what the reaction is after today's report. Stay the course with the names that you own unless the fundamental story has changed. We've talked about that numerous times. Your cash is earning 5 or 5.25% if you're in a money market fund at the moment. So there's nothing really to worry about. As a long-term investor, remember, you need to eliminate a lot of the noise and focus on the plan. Discipline is key. As a short-term trader, all you want is the noise, right? And you have to decide, once again, who you are. Are you a long-term investor or are you a short-term trader? Because that's going to make a difference in how you view the activity and how you view your investments. Okay, so we're going to have a dinner tonight. We're going to have the porcini rubbed ribeye, and we're going to serve it tagliata style. Now, for this, you need the dried porcini mushrooms. You need sugar, salt and pepper, garlic, olive oil, balsamic vinegar, a boneless ribeye. You can use a bone-in. A bone-in ribeye is always delicious. Arugula, red onion, shaved Parmigiana cheese, and you need 1 lemon. You're going to grind 1 ounce of the dried mushrooms until they're fine, right? You can use like a mortar and pestle, or you can use a food processor if you need to. Next, combine the mushroom powder with 2 tablespoons of sugar, 1 tablespoon of salt and pepper, 4 garlic cloves that you've chopped, and about a 1/4 cup of olive oil. Set it aside. Now, you can make a container of this and up to this point, and then keep it in the fridge in a sealed jar and use it, in future dishes. But right now, that's what you want to make. When you're ready to use it, you're going to take it out of the fridge if you've put it in the fridge. Otherwise, you're going to just take it, open it up off the counter. You're going to mix it again, and then you're going to massage your meat, right? So you're going to massage the ribeye, whether it's bone-in or boneless. You're going to massage it on all sides and get it all nice and delicious. Season the meat with salt and pepper. Season the meat with the ribeye. You can add a little bit more salt to it if you want, but be careful because you put salt in the rub. And then make sure that it's coated on all sides. Now preheat your oven to 400 degrees. And on the stove top in a large cast iron skillet, you're going to add about 1 tablespoon of olive oil, and you're going to heat it up. You're going to add the steak wait till it gets really nice and hot. Add the steak, you're going to hear it sizzle. Brown it on both sides. So let it sizzle on one side, then let it sizzle on the other side. You don't need to cook it there because you're going to cook it in the oven. Just get it nice and sizzled. Now put it in the oven and let it cook for about 5 to 8 minutes, depending on its thickness. If you have an instant read thermometer, you want it to read 135 degrees when inserted into the center. If it is, then remove it, let it stand for 10 minutes, but tenting it to keep it warm. Now, when you're ready, you're gonna slice the steak at an angle so that you can fan it out on the plate. Lay down some arugula and red onion, place the steak on top, and then drizzle it with a bit more olive oil and a squirt of fresh lemon juice. Then top it with the shaved Parmigiana cheese. Oh my God, delicious. Okay, so here we are. Like I said, look above. It looks like a little bit, dark and cloudy, dark and stormy right here, but we'll see. 8:30 is just around the corner. Take good care.